provider. Okay, so Captain Positive.
I'm ready to fight.
Went on a date. That's what you said on social media. You and Wandile Sehlobo, the most respected agricultural economist in the country, went on a date. That's what you said on Twitter.
Sorry, Wandile. I apologize for putting it out there in the public.
What you meant to say was something about a date, but you actually meant to say data.
Yeah, data.
You've been using Wandile Sehlobo's data. So the theme of our discussion this evening, South Africa is in recession, and it's horrible, and we feel poor, and we feel maligned and abused and grumpy. And as a result, people start spending less and people start cocooning more, and people's investment habits changed. It happened to Julia in the financial crisis, and she looks back at that time and regrets that she lowered her investments as the markets were falling, because she could have bought so much more with so much less money. And that's her one regret, is not investing through a crisis. So tell me why we should ignore this recession.
Well, I think I think that's the point. She did that in the middle of a stock market drop. And that's the key difference here. So we're sitting in a car that's going at 100 k's an hour, and suddenly we realize that we went over a speed bump 3 minutes ago, and we're hundreds and hundreds of meters past that already, and now we're looking back and going, oh my gosh, we went over a speed bump. Well, guess what? It happened. It's over. It's now ancient history.
As long as you didn't hit it too hard and hit the sump and your oil's all leaked out and your engine is seized.
But you would know because you're in it.
Yeah.
And that's my problem with this fascination with GDP that we have is to me not misguided. I mean, I'm not saying that it's totally irrelevant, but from an investment point of view.
It's all we've got, though,
No.
to gauge
No.
a sense of where an economy is.
I don't agree. I mean, I think that we know we feel. I mean, we can already tell we're feeling poorer. We can already that we know now, and it's live, and that's what we should be focusing on. As an investor, worrying about what happened at the end of June is pretty much irrelevant. It might give you some kind of weird fuzzy indication of what the future possibly could look like, but actually it's a waste of time. To worry about South African GDP for a South African investor who wants to know about what I need to do with my money for the next 5 or 10 years, you've got many better things to worry about. And one of them is the rand and is the fuel price. I agree with those things, but those are live. And what we should be worrying about is what are they going to do in the future? And what kind of struck me when I looked at this was now Wandile Sehlobo, and looking at this GDP number, because I thought, okay, well, I studied this stuff a long time ago, and I figured out by then it was pretty much irrelevant, but let's look at it anyway. And he writes here, and he goes, this stuff relates to what happened in year-on-year change. So what we're talking about is the tail effects of a drought in the Western Cape that no policy in the world could have dealt with. There was no way. That's over. And then a really good maize harvest that just happened at a slightly different time. So what we're measuring is difference in prices and difference in growth and difference in lots of different things from 12 months ago to now, or 3 months ago to now. And now we're getting all hooked up on this stuff. And it was all about agriculture in this particular set.
It feeds into our cognitive biases. It feeds into the narrative we wish to paint. We're sitting in an environment where there is policy uncertainty. And Colin Coleman, just before Eyewitness News, was painting that particular picture of the Reserve Bank and the land debate and the mining charter and all of those things. You then get some bad news about a recession that has happened. We may still be in a recession. This quarter doesn't feel any better than the last two. We may still be in a recession. We don't know officially or not, and does it really make a difference? But we want to believe that all of these things are connected and interconnected and dependent upon one another because it feeds a particular narrative.
Yeah, and I think that's the point is, so we do need a change of sentiment here. We do need to see signs from government that real action will be taken to get things going in the economy, and not just sort of political rhetoric that appeases the popular side of what we need to do for an election. So then I went and I decided to approach another well-known economist, a guy called Mike Schuessler. Because my feeling is if we really want to get depressed now, we've actually been in recession for quite some time. That's my feeling. And economists get so hooked up on this GDP number, and I hate the phrase technical recession. You're either in recession or you're not.
We're in recession.
But actually, we've been in recession for quite some time.
This is what people say is if your population rate is growing faster than your economy is growing. So if you're growing the number of people in your society by 2% a year and your economy is growing by 1%, you're going backwards and going backwards fast because you're not creating future opportunities for new people.
Exactly, and we've been there since 2015. In fact, what the other thing I'd add to that population and economic growth is then the impact of inflation. So that the economists, they love these names. They've got fabulous names. So this is GDP per capita in real terms. So now you're taking inflation into account, and since 2015 we're down. We are going backwards every single year, and we have been. So, why aren't we going crazy about that? Well, the point is, we've hit the speed bump. All the problems are known. So now what we need to do is look forward and say, okay, do I now kind of sell all my shares because of what happened, months and months, and now actually, in fact, years ago, and sit in cash, because interest rates are there, and see what happens and wait for everything to get better. Well, that's really going to be a dumb decision, in all honesty. That's not the way to make investment decisions. And I think, to try and give a perspective on this is to say, are we actually possibly in the darkest time now before the dawn? Because there's quite a lot going on. I still think that's good. There's a lot that's bad, but it's actually known. And a lot of the stuff that we're hearing about and all these commissions, etc., is telling us what's already happened. It's bad, and it's much worse than a lot of us thought, but it's happened already. And I think we've already stopped digging. And I think that's the point now. And to me, if we're going to look at an economy that has a big impact on our investments, we should really worry about a couple of things. One, we should worry about what the US economy is doing. Do you know that there is a bigger correlation between what happens in the US economic numbers and our market than there is between our economic numbers and our market? There's more correlation between weather patterns than our market than there is between our economy and our market. So let's not get hooked up on our economy and our market, because a lot of what our market is made up of is international shares.
Correct.
Operating all around the world. So that's what we should be looking at. We should be looking at global growth and saying, is that okay?
Okay, explain to me this then. Johan Bierman, who likes to tweet interesting things, tells me on Twitter this evening that the JSE is down 22% this year in US dollar terms. Yes. Now, if 70% of the earnings of the top 40 shares in the JSE, which make up 90% of the value of the JSE, is outside the country, why are we getting nailed in US dollar terms so hard?
Well, I think this is now feeding into what's going on in emerging markets. So remember, emerging markets in general, there has been a sell-off there, and I think that's what's affecting us here. So the rand has weakened dramatically in a short period of time. The earnings that you're talking about, remember, they come through in time. They don't happen, so the company's generating revenue, and it only reports that revenue every 6 months, for example. So investors need to see that. And in the meantime, what's happening is, Argentina is really doing their best to mess things up, and all the brats, I think you called them, didn't you?
I did. Brazil, Russia, Argentina, Turkey, and South Africa. It used to be BRICS, and then it was Civets, Colombia, Indonesia, Vietnam, Egypt, Turkey, and South Africa. That was a positive one. The Civets were going to be the agile cats that were going to navigate the future. And then there was there were so many acronyms, but my favorite one ever is brats, because there's a bratish emerging market response to what's happening in the world.
Yeah, and I think that's the issue now, is that people are looking at what's going on in those, especially now in Turkey and Argentina, and saying, is this the beginning of another emerging market crisis like we saw in late 1990s? I think 1998 was the really big year for that. And I think the difference is we look nothing like Argentina. There's some similarities, as you were saying, with the cognitive bias. If we really wanted to be negative, we could draw a couple of parallels. But actually, right now, I listened to 6 different fund manager companies presenting today, and a lot of them are looking at our country and saying, all of a sudden, something like state-owned corporate governance, which was a huge concern months ago, is not a concern anymore. The economy, yes, it's a concern, et cetera, but we're starting to tick a lot of the boxes again. Treasury's great, the Reserve Bank's great, all of those things. Judiciary's always been fine. So a lot of the institutional rigidity and strength that we need is there, and some of the institutions that were being attacked are being corrected. So the system is self-correcting now, which is great, and it needs to carry on.
At some point, markets, despite how we feel, offer value. In other words, it's a good opportunity to buy more shares or some shares or your first ever shares in a stock market. One looks at the fluctuations on a daily basis, and I get befuddled because the rand goes up half a percentage point or loses half a percentage point, and rand hedges either fly or fall, and banks, either South Africa is dead and SA Inc. companies like the Bidvest and the Imperials of the world fall on their faces, and tomorrow they're back up again. And it's because it's so choppy and so difficult to make sense of. People go, it's too chaotic. I'm going to stay out until there is certainty.
Wait for things to get better.
Yes.
And what's so interesting about the SA Inc. story is if SA Inc. is so terrible, how is it that some companies can deliver decent results in this environment?
How did First Round grow 12%?
And that's my question. So, and how is it that, and I guess now their big competitor, soon to be big competitor Discovery, launching a bank in this environment. So my view is that I think you make a huge mistake now by sitting on the sidelines as an investor. I'm not saying go and buy every small company on the JSE that you can possibly find. Do your homework, be careful, because there are some companies that might still hit the wall, and that's really unsettling to see. But what is interesting is the companies that get through this. You just did the talk with the interview with Spur. So the companies that are learning lessons now, the hard lessons that are right sizing and getting their product lines right and their profitability right, when the things turn, those are the companies that deliver fantastic results. And someone said about don't waste a good.
I hate that. I was about to say I hate the cliche. Don't waste a good crisis, but it is so blimmin' true.
And from an investment point of view, that's what I'm looking at now, is the great quality fund manager and specifically company managers that are looking at this and not giving their teams the excuse of saying, oh, you know what, you're in the construction sector and, it's tough times for construction. They're saying to themselves, what do we do to do things differently? How do we make money in an environment like this? What markets can we capitalize on? What are the opportunities there? And those are the businesses, to me, that are setting the platform now for, the 10, 20 baggers that all the big, fund managers are looking for. And what's really interesting is listening to these fund managers, there is more and more kind of appetite again for SA Inc. businesses. Yes, they're really careful about which ones they're buying, but they are. And from my perspective, getting now hooked up, I'm bringing it all the way back to the beginning of my rant about the GDP number. I think we're wasting our time as investors. I think we're right to be angry. We should be angry with bad policy, bad implementation.
It's a warning, but let's use it then as a warning signal. Let's say, okay, fine. It's a bit like the flare from the Titanic. Had the Carpathia been closer and responded a bit more quickly to the SOS messages, it could have got to the Titanic. If you ignore the signals that are sent, and the GDP numbers are a signal that things are not going well, fix them.
Correct.
And if you can do that, then you're okay. And the president keeps promising this big stimulus package. I don't know where he's going to get the money from. I don't know where he's going to direct the money. I'm fascinated to see it. I'm just hoping he puts it in the right places. And the right places are in small businesses with a bit of a track record that employ at least 10 people. They've proven they can turn capital into value. That's where the money's got to go. And I hope he doesn't pee it up against a tree.
And if you listen to the people that have been reaching out to him, he's listening. They're being listened to. So,
and Pavlopatidis is he's now doing dancing and is, I think ululating. Thank goodness he's outside the studio. But just to give you a sense of the headspace of our listeners, and you're not listening to us, our dear listeners. We're only just starting to get poorer. Yes, you are, if that is your approach and your attitude. Argentina has better property rights than South Africa. You can have all the property rights that you like, but if your economy is mismanaged to the extent that Argentina's is mismanaged, your assets have less value than assets in South Africa. And then, Jeffrey, will you be podcasting the Spur interview? We podcast everything. We always the Money Show. Every day, all day, podcast, bedungest.
We've never had an inflation problem. For the last 20, 25 years.
Inflation targeting, in other words, getting, raising interest rates when inflation starts to look a bit bubbly, brings it down again. We've been very good at managing inflation.
And that's the big difference between us and Argentina. They seem to thrive on borrowing too much and then this inflation issue. So they haven't had the kind of central bank we have always had. And I think that's the biggest difference in one sentence.
That's why you don't mess with the central bank.
Exactly.
Don't get me started. Otherwise we won't give Pavlo a turn. And then you don't want to do that.
And Tara's looking at us.
Oh, look, it's at the time already.